Since World War II, there haven't been as many armed conflicts in the world as there are at this moment. There are 61 armed conflicts involving at least one nation-state, the highest number since 1946, 79 years ago. Of these 61, at least 11 have reached the status of war, defined as a conflict causing at least 1,000 battle-related deaths. In other words, we are living through the most fearful and uncertain times of the last 8 decades. The world is in crisis, as revealed by the Uppsala Conflict Data Program, UCDP, the most widely used source on organized violence in the world and the oldest ongoing project collecting data on civil wars. Given this reality, it's no surprise that gold is not only at record highs, but growing parabolically. Gold has risen almost vertically since 2023. Considering the global uncertainty context, which includes not only armed conflicts, but also trade wars initiated by Trump, especially regarding China, expectations of interest rate cuts amid rising fiscal deficits and US government shutdowns, the current demand for gold is understandable. In the event of a 10% drop in the value of the dollar, Ken Griffin, CEO of Citadel, one of the most profitable hedge funds in the world, says that capital is moving to de-dollarize and reduce exposure to US risk. In the first half of 2025, central banks worldwide purchased 415 tons of gold, led by Poland, China, and Turkey. However, investment demand, via ETFs, bars, and coins, exceeds central bank purchases by almost 1,000 tons, indicating that institutions and retail investors are the most interested in turning to the precious metal as a safe haven amid uncertainty. Looking at the comparative chart between gold and Bitcoin, BTC, while historically their correlation has been low in this moment of global uncertainty, they seem to be converging. But the period is still too short to claim they are truly correlated. For years, especially after the largest dollar printing in history during the COVID-19 pandemic, the dominant narrative around Bitcoin has been as a store of value and inflation hedge, possessing monetary qualities similar to gold. From this perspective, institutional investors have positioned themselves in Bitcoin as a long-term wealth preservation asset. The world's largest asset manager, BlackRock, has stated that Bitcoin is a hedge against risks that traditional assets cannot address, particularly during periods of greater geopolitical and economic uncertainty. And its CEO, Larry Fink, highlighted that Bitcoin is an instrument you invest in when fear is greatest. But BlackRock is not alone. Fidelity, with over USD 15 trillion in AUM, has called it exponential gold. VanEck, a global asset manager and emerging markets pioneer, projects it as a global reserve asset. Ray Dalio of Bridgewater Associates, whose flagship fund manages USD 92 billion, equates it to gold against debt assets. Cantor Fitzgerald, a leading institutional brokerage with USD 16 billion in AUM, also says Bitcoin should be treated as gold. Deutsche Bank, Paul Tudor Jones, Stanley Druckenmiller, and even the US Treasury have referred to Bitcoin as digital gold. Despite these high-profile endorsements, it's often overlooked that these still represent a relatively small portion of the market, and there remains a large, perhaps even larger segment that still views Bitcoin as a risk asset. This is evident in the growing correlation between BTC and the S&P 500, which has remained high since September 2024. The correlation between Bitcoin and US equities implies that investors perceive Bitcoin more like a tech stock. Bitcoin currently occupies a hybrid or transitional status, halfway between a risk asset and a safe haven. Movements in gold prices could be decisive in determining how BTC consolidates in the near future. For the largest US bank, JP Morgan, Bitcoin, and gold are in a zero-sum competition to lead what they call devaluation trading, an investment strategy to hedge or profit in times of economic uncertainty. In this scenario, JP Morgan projected that BTC would take the lead. We expect the zero-sum competition between gold and Bitcoin to continue for the rest of the year, but we believe specific catalysts for the digital asset will generate greater upside potential for Bitcoin over gold in the second half of the year, the analysts stated. VanEck shares this view, asserting that Bitcoin's intrinsic characteristics, combined with growing institutional and technological adoption, strengthen its long-term potential over the precious metal. Furthermore, the firm says its clients are more interested in Bitcoin than in gold. Much of this demand may stem more from speculative appetite than from true safe haven demand. While this may seem like a minor narrative nuance, in times of uncertainty, when fear drives more cautious investment decisions, it can be decisive in determining where money is placed. Although Bitcoin's price has increased slightly more than gold in 2025, there is a USD 28 trillion difference in capitalization between gold and Bitcoin. In other words, gold's market cap is 13 times larger than Bitcoin's, requiring far more money to move its price. To compare how much money has flowed into each, ETFs provide a reasonable metric. While not the only investment vehicle, they are a comparable measure. In 2025, Bitcoin ETFs have received USD 30 billion, while gold ETFs have seen USD 64 billion, more than double. Despite the limited scope of this comparison, it shows that gold still outpaces Bitcoin in investment volume in this contest for the dominant store of value. Much of the money expected to flow into Bitcoin is actually going into gold. However, another perspective is that if Bitcoin did not exist, gold inflows would likely be much higher. This is the first time in modern history that gold has faced a competitor as a store of value, and in just 16 years, Bitcoin has captured nearly half the investment volume of an asset that has served as a refuge for millennia. And just as it's the first time gold has faced a competitor during its boom, it will also be the first time it competes during a downturn. Markets work this way. Prices act as a social coordination mechanism and a public opinion thermometer. During storms, worst-case scenarios are priced in, potentially inflating prices. Once the storm passes, the thermometer readjusts. After Richard Nixon broke the gold standard during the Vietnam War, gold prices first surged amid great uncertainty while other assets fell. Later, in the 1980s, Fed Chair Paul Volcker raised interest rates to 20%, curbed inflation, made the dollar attractive again, and gold prices fell. Gold remained low and relatively stable through the 1980s and 1990s, during a period of prosperity and confidence where a safe haven was less necessary. In the 2000s, the dot-com bubble burst, the 9/11 attacks occurred, the subprime crisis hit, and massive money printing began to save banks and mitigate the crisis. In this new period of uncertainty, gold reached new all-time highs. Between 2012 and 2018, with slightly more economic stability, interest in gold and its price declined again while stocks rose and the dollar strengthened. Before the current parabolic rise, gold had already reached a record high during the COVID crisis due to inflationary pressures from massive money printing, increasing distrust in the dollar. Additionally, the dollar AS used as a tool for sanctioning adversary nations has amplified the demand for alternative assets among dissenting countries. While all crises eventually pass, we cannot know in which phase of the crisis we currently are. Therefore, we cannot predict how long the demand for store of value assets will persist. Some analysts, like Credit Suisse's Zoltan Pozsar, believe we are entering a new monetary order, implying a deeper and likely longer-lasting shift than prior crises. Meanwhile, as long as global uncertainty continues, the battle between gold and Bitcoin for the dominant store of value will persist. This outlet opines that once the storm subsides and the gold bubble bursts, Bitcoin will benefit the most. Despite the large monetary expansion in recent years, money is not infinite, resources are limited, and investors must decide where to allocate it. So far, when the need for a safe haven arises, more money has gone into gold than Bitcoin. In the short term, during this transitional phase for Bitcoin's narrative, this may seem rational, but the long-term opportunity cost likely favors investors who chose Bitcoin over gold. Currently, Bitcoin is in one of the most unpredictable periods in its history. The entry of new actors such as ETF managers, corporate treasuries, and even some nation-states, mostly focused on long-term accumulation, has challenged the 4-year boom and bust cycles tied to each halving, or at least reduced their intensity. This could lead to greater price stability, reinforcing Bitcoin's transition from a risk asset toward a store of value. In a scenario of economic stability and geopolitical certainty, gold demand would vanish, but Bitcoin would continue its adoption phase, reaching investors with ever deeper pockets, including states. However, this is not the current reality. Gold remains the dominant store of value because it has something Bitcoin cannot compete with: millennia of history as money. The Lindy effect, in Nassim Nicholas Taleb's words. Although Bitcoin may surpass gold in monetary qualities like programmability, portability, divisibility, verifiability, and custody, it still occupies this hybrid perception in the market, viewed more as a risk asset than a store of value. For now, tradition wins, but likely the most advanced monetary technology will prevail in the long term, as gold becomes progressively demonetized in favor of Bitcoin, with more individuals, companies, and states participating in this transition.